When people first start talking to lenders, one of the numbers that tends to stand out right away is the pre-approval amount. It often feels concrete, specific, authoritative. Someone runs the numbers, looks at income and debts, and says, "You're approved up to this amount." For many buyers, that moment's really exciting. It makes the idea of shopping feel real. At the same time, it can be really confusing because almost immediately another question follows. Is that actually what I should spend? Not what I can spend, but what I would feel comfortable carrying month after month. What most people are really trying to sort out is this. Why is my pre-approval higher than what I want my payment to be? Why does my own budget feel tighter than the lender's number? What costs are included in the lender's calculation? What expenses am I thinking about that underwriting is not? And how should I use that pre-approval responsibly when making offers? So those questions usually come up from buyers who are trying to be careful. They want the room in their lives for savings, for repairs, for vacations, for childcare, or just for unexpected things that come up over time. They're trying to understand the structure before committing to anything. So in this video, I'm going to walk you through why a lender's pre-approval amount and a buyer's personal comfort budget are often two different numbers. We'll talk about what lenders are required to evaluate, how payments are calculated under federal rules, what personal budgets usually include that underwriting does not, and how to use both numbers together when you start to look at homes. Before we compare a pre-approval to a comfort budget, it helps to understand what a pre-approval is actually meant to accomplish. From a regulatory standpoint, mortgage lenders are required to evaluate a borrower's ability to repay. That means documenting income, reviewing debts, looking at credit history, verifying assets, estimating housing costs, and just making sure the loan structure falls inside the rules of the program being used. So federal consumer protection rules focus on whether a borrower can reasonably make the payments as scheduled. That's the lens that underwriting uses. A pre-approval is an early version of that process. It is designed to answer a specific question. Based on the information provided so far, what loan size appears to fit inside the program guidelines and federal repayment standards? It's not designed to answer a different question, which is what monthly payment would feel most comfortable for this particular household's lifestyle. Those are related, but they're not identical. When lenders look at affordability, they focus on the mortgage payment as it is defined under federal disclosure rules. That full housing payment generally includes principal and interest on the loan, property taxes, homeowners insurance, mortgage insurance when applicable, and HOA or condo dues when those apply. Those components together form what many people call the total monthly housing payment. So federal regulators require lenders to present those figures clearly in loan disclosures so that borrowers can see the full cost of the loan. That structure is intentional. It ensures the core housing expense is captured in a standardized way. What that calculation does not include are the many of the day-to-day cost of living that exist outside of the mortgage itself. So groceries, utilities, gas, cell phones, streaming subscriptions, daycare, medical expenses, student loan payments are included, credit cards are included, car loans are included, but many other household costs are not part of the underwriting ratios. That difference is one of the biggest reasons pre-approval amounts and comfort budgets drift apart. When buyers think about what feels affordable, they usually take a much broader view of their finances. They're not only asking whether a payment is technically allowed under lending rules, they're asking questions like, how much do we want to save each month? What does our grocery bill usually look like? Are childcare costs changing? Do we travel regularly? Are we supporting other family members? Do we expect income changes? Do we want room for hobbies or projects? How much of a cushion feels safe? So those considerations are personal. They vary from household to household. So two families with identical incomes and debts on paper may land on very different comfort numbers. So one may prioritize aggressive saving, another may value flexibility for travel, another may have medical expenses that are not captured in any underwriting ratio, another may simply sleep better knowing there is a larger buffer each month. So lenders are not ignoring those realities, they're just not allowed to build them into the qualification formulas. So federal rules focus on repayment ability, not lifestyle design, and that distinction is very important. Sometimes buyers receive a pre-approval and immediately think, that feels bigger than what I imagined. That reaction usually comes from a few places. One is that underwriting calculations are based on gross income and not take-home pay. So taxes, health insurance premiums, retirement contributions, those come out of your paycheck, but they're not part of income calculations for mortgage qualification. Another factor is that underwriting focuses on documented recurring debts. So if a household is very disciplined about saving or spending conservatively, that discipline may not show up anywhere in the loan file. The lender sees capacity, the buyer's thinking about preference. There's nothing wrong with either perspective. They're just simply answering different questions. Another piece that shapes a pre-approval is the structure of the loan itself. Interest rate, loan terms, down payment, mortgage insurance, property taxes in the area, insurance costs, and HOA dues. So those inputs can change the monthly payment even when the purchase price stays the same. So for example, a longer loan term usually lowers the monthly principal and interest portion. That can support a higher purchase price under that same qualification framework. A shorter term does the opposite. Mortgage insurance can increase the payment. Higher property taxes can increase the payment. Homes in different neighborhoods can have very different tax bills even at similar prices. So those variations are why pre-approvals are always tied to assumptions. They are not promises. They are just snapshots based on a structure that can change as you shop. It can help to picture two buyers with the same income and debts. They receive the same pre-approval amount, but one buyer is comfortable spending close to that maximum because their other expenses are modest. They save a little each month, they have no major upcoming changes, whereas the other buyer wants to stay well below that number. They are aggressively saving for retirement, they expect childcare costs to rise, they travel to see family, they want room for repairs. So from an underwriting standpoint, both households may qualify for the same loan, but from a lifestyle standpoint, their comfort budgets may be very different. That gap does not mean the lender made a mistake. It means that the buyer is applying personal priorities to a standardized system. Federal mortgage regulations were created in part to prevent loans that borrowers cannot reasonably repay. They require lenders to verify information, to calculate payments in a standardized way, to disclose cost early, to avoid structures that depend on unrealistic assumptions. So those protections are meant to keep borrowers from being approved for loans that ignore documented financial realities. They're not designed to optimize for every household's preferred lifestyle. This is where personal budgeting comes in. Think of the system as setting up the guardrails. Inside those guardrails, buyers still get to choose where they want to drive. One of the healthiest ways to think about a pre-approval is as a planning tool, not a target. It shows the ceiling the current structure supports. It gives you negotiating credibility when making offers, and it helps agents know what range to search in. It allows sellers to take your offer seriously. What it does not require is that you shop at the very top of that range. So many buyers choose to aim lower. Some choose to leave room for future expenses. Some want to keep cash reserves. Some want the flexibility if rates change before locking. So using your own comfort budget inside the pre-approval framework gives you control. You get to decide what feels sustainable. Before homes start pulling at your emotions, it's often helpful to slow down and work through a few planning questions. These tend to surface clarity. What monthly payment range would allow us to save consistently? How much cushion do we want left after bills? What expenses are likely to change soon? How stable is our income? Are we planning major life changes? How long do we expect to stay in the home? And how important is flexibility to us? So those answers do not come from underwriting guidelines, they come from self-awareness. Pairing them with your pre-approval gives you a much stronger foundation when it's time to write offers. Another reason comfort budgets and pre-approvals sometimes drift apart is that shopping itself introduces new variables. Property taxes differ, insurance quotes differ, HOA dues vary wildly, rates move up and down payment plans can change. So each of these can reshape the payment. So a home that fits perfectly inside your comfort budget on paper may feel different once you see the full housing cost. So running updated scenarios as you look at specific properties helps keep surprises small. It also prevents you from anchoring emotionally to a house that stretches things further than you want. As buyers go through this process, a few misunderstandings tend to repeat. These are the ones that usually benefit from early clarification. Thinking the pre-approval number is a recommendation rather than a limit, assuming everyone should spend the maximum they qualify for, forgetting to include taxes, insurance, or HOA dues in the early budgeting, believing lifestyle expenses factor into underwriting ratios, and then waiting until after an offer is accepted to test your comfort levels. Clearing those up early often leads to calmer decisions later. A lender's pre-approval amount and a buyer's comfort budget serve different purposes. The pre-approval reflects what fits inside the regulatory and program guardrails based on documented financial information. Your comfort budget reflects how you want to live, what kind of flexibility you want, how much risk you want to carry, and what you want your month-to-month life to feel like. The strongest buying decisions usually come from using both, understanding the system and then applying your own priorities inside of it. If you're thinking about buying and want to understand how your pre-approval amount compares to what feels comfortable for your household, Use the link below to book a call with my team. These conversations are most helpful early before an offer is written because they can save time, stress, and surprises later. And if you want clear explanations about how lending rules actually work in today's market, make sure to hit that subscribe button. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you in the next one.